Oh, because cap gain. Okay, otherwise it's yeah.
Well, it's not just 20% cap gains?
No, maybe oh, it's ordinary income?
Thank you for taking the time today and joining us. We are Whitman College, and I'm Jack. This is Kyle, Michaela, and Sawyer, and we're presenting on Heckler Mining Company. So first, at the price of $6.34 as of January 28th, we gave it a buy recommendation at a target price of $7.62 with about a 20% upside. So Hecla is an American mining company with mines also in Mexico and Canada. It is the largest silver producer in America, and it also produces gold, lead, and zinc. So then to highlight the market profile, if you look at the 52-week high and low, you can see it is a quite volatile stock. It has a 2.5 billion market cap, and then it has a low dividend yield of 0.16%, and it does not have a PE because it's not profitable at the moment, but it does have a positive operating cash flow.
For our industry analysis, we start off with the silver market, specifically silver demand. For jewelry, it's held about steady. Coins and bars have increased pretty significantly in the past year. Silverware has also stayed about steady, and industrial fabrication has decreased pretty steadily. 2015, 50% of all silver demand was from industrial fabrication. 19% was from jewelry, 25% from coins and bars, and 6% from silverware. Here's a breakdown of the industrial fabrication. Going to the gold market, gold demand, jewelry felt the jewelry decreased pretty significantly in the past year. This is from the shift from fine jewelry to fashion jewelry, which is from pure silver and gold to plated alloys. Technologies held about steady. Investment has increased pretty significantly due to a significant increase in the popularity of exchange-traded products with gold, and central bank demand has decreased. In 2015, gold demand was made up of 56% jewelry and 21% investment, compared to 2016, 50% jewelry and 34% investment. Pretty significant change. For capital expenditures within the mining industry, we've seen a pretty significant decrease since 2012, its peak, and this suggests that supply of these precious metals will likely not increase in the coming years. Many companies in the mining industry have turned to methods of alternative financing, and the chart shows in 2009 and 2012 there was increases, and in 2015 there were 3 deals in the United States worth $3.2 billion. Hecla does not engage in these streaming transactions, which gives them full access to the revenue from their reserves. For our competition analysis, we created a report of 5 forces. Some guiding factors in this was the fact that it's a very high cost of capital, so there's a very low threat of entrance, and also that Hecla enters into a commodity market with its products, so it's pretty tough to have a competitive advantage for their specific products. For some key financial ratios, Hecla's forward price to earnings ratio, the price to book ratio, and the price to cash flow ratio all are close to within the industry average. Price to sales ratio, however, is significantly higher than the industry average. And we attribute this to their lack of alternative financing. So they do have a higher exposure to the revenue from their reserves, and stockholders believe that this will create more revenue in the near future. For some EBITDA ratios, we have enterprise value to EBITDA is slightly higher than the industry average, and their net debt to EBITDA is significantly higher than the industry average, which again makes sense because they don't engage in these alternative financing deals, and they take on more debt, however, have more potential upside. So for Hecla's gains, Hecla's equities gained in the past year, they've gained over 150%, and this is much higher than the industry average. They've done so with a lower beta than many of its small cap competitors, and this shows that Hecla's been able to provide higher risk adjusted returns than many of its competitors.
So when we did our financial analysis, we looked at Hecla's profit metrics, and we concluded that they had very volatile earnings. And we also saw their free cash flow and net income decrease due to depreciation and acquisition of some of their mines. And so during our financial analysis, we also looked at their EBITDA and net margins as well, and concluded they have very volatile margins with that same fluctuation, depreciation, or acquisition and depreciation from mines.
For our valuation, we focused primarily on their reserves. That's the largest green bar there, around $3.3 billion. We also looked at some of their assets and liabilities that we thought were pertinent. We also tied in value that was added, or in this case, destroyed, by management reinvesting money back into the business. For reserves, we focused on the four commodities that they mine, and we focused exclusively on proven and probable reserves, meaning we did not look at more risky reserves that maybe were there, maybe weren't. And then we projected them out over how many reserves they had, given 2015 production rates, so not increasing them over time. And then we discounted annually for their average cost of capital. And these are the commodities broken down by category and the total value. An example here is silver, which is their largest and most valuable commodity. The blue numbers here represent the 2015 production rates going out over the lifetime that it would take to mine all of their reserves. And the gray number represents the discount based on 6%, which was our calculation for their WACC. Additionally, we think there is some other possible upside, given that production rates have slowly increased in the past, and it is possible, but not certain that they will increase in the future. For their assets and liabilities, we focused on what we call auxiliary assets. These are assets that we found not pertinent for day-to-day operations. And in addition, we focused on their long and short-term debt, which is around $500 million. For destruction of value by management, we found that over the past 10 years, they've averaged around $165 million investing back into the company's reserves and mines. However, that returned less than 1%, or around $1.4 million. This ended up being negative when you take into account their cost of capital, destroying around $8.5 million, with a terminal value of around $142 million that was subtracted from the value of the firm. For other valuations that we chose not to use, such as the DCF, comparable company analysis, or discount dividend analysis, we thought that they would not be very useful, given that Hecla's earnings and cash flows are quite volatile. You can see 2006 through 2015. And we thought any projections given such volatility would likely be inaccurate. Additionally, their dividend is quite small, usually between 0.1 and 0.2%, and it fluctuates based on the price of commodities, and such a model would require us to project commodity prices out over a long period of time.
Now, to go over some of the risks that we saw when we were doing our research at Hecla, we saw that some of the potential risks that were potentially good catalysts in the future or negative. We looked at their lack of hedging. So Hecla doesn't hedge their prices for gold and silver, which means that they can kind of choose when to sell these and at which prices they so choose. But we also saw this as a negative because they don't set their prices in the future. And so if the gold or silver market were to fall, it would be a negative for their company. Also, one other thing to mention is their management turnover. They mentioned in our initial presentation that in 5 years, some of their management might retire. And then changing in regulations. So with the Obama administration, we saw a lot of regulations, but with this future Trump regulation, we might see, or administration, we might see a bunch of deregulation. And then lastly, we saw that there was a rising stock price, and this follows our trend. This follows our anticipated trend towards our target price, but it also is increasing towards our target price. But so potential downsides are, like I mentioned, the lack of hedging and CERCLA 108B, and like I said, the rising stock price. So for our investment summary, we saw that potential decreasing regulations was a positive for Hecla, as well as they have no alternate financing, which means that they have full access to the revenue for their reserves. And we estimate that this should be a definite buy, because the market undervalues their resources. And when we did our analysis, we saw that there was an upside of around 20.2% when we initially did our analysis. Are there any questions?
I have a quick one. So you guys, under your risk section, you mentioned CERCLA 108B. What is that?
So CERCLA 108B is a bill that's still being considered, and it's it's for reclaiming their mine. So when they're finished their mine, they have to pay money to reclaim it and to make sure that the land is okay, or to like certain standards of the EPA. But since the Trump administration might not want to pass that, or the EPA might not have as much power over that, that regulation might not get passed, so they might not have to spend as much money.
So it's a risk and a potential catalyst.
Right. So it could be seen as a risk if it does pass, but if it doesn't pass, then they wouldn't be concerned with it.
For your competitors, which you had on your earlier slides when you were doing some comparison, how did you pick the ones that ended up with us?
Yeah, so we picked a few similar small cap competitors such as Core Mining, and we picked a silver streaming business, Whitman. We also picked an industry leader who Hecla kind of wants to emulate, Newmont Mining. We also picked some of the largest mining companies in the world, Barrick Gold Corp and KGHM Polska.
Is there a reason why you didn't include Pan American Silver? I mean, I think they're one of the only other comps that's like a pretty high percentage. They're a very large percentage silver producer.
Yeah, I mean, not a specific reason. We just thought the others would be more representative of the industry as a whole.
So when looking at like such a wide range of comps, were you worried that you would be comparing, in a sense, apples to oranges when you're looking at small cap versus large?
Possibly, but also Hecla does want to become more like a lot of these large cap stocks, and so we thought that if they were to attempt to emulate them, we should compare them at this stage.
So what commodity prices did you use when you were valuing their reserves?
We used the prices from the 2015 10K and the average prices that they were able to sell them at.
And how do those prices compare to the current prices in the spot market?
We have not done a full analysis of that, but I think they're up a little bit, which would create a little bit of an upside. And we think probably will lead to some potential capex in the future, but not certainly for a little bit of time.
I guess their reserves are undervalued. Do you see them as an M&A target? And if so, what premiums are generally paid in the market for mining and M&A?
We didn't particularly look at them for mergers and acquisitions. I mean, I think even if management says that it isn't destroying the value that we calculate to destroy, it is still very worthwhile as a buy. We would value them at what their reserves are.
So my other question would be, so in terms of the M&A steps, I believe that they've kind of grown through acquisitions over the years. Did you guys look at in terms of their organic growth versus growth via acquisition? And how should we think about that?
We did not. We grouped them all into one kind of general growth.
So if you value them basically on their reserves, why would an investor choose to invest in a Hecla or mining rather than directly in a commodity?
I think because commodities are generally valued at what they are, whereas we feel that the market is simply undervaluing their reserves right now. So this gives you, I would say, a value play into it.
On the risk side, did you guys look at corporate governance at all in terms of what policies they have in place, and then along kind of those same lines, executive comp in terms of how highly paid the CEO and CFO are relative to other industry players, and then maybe as well whether or not what the manager's ownership is. Do they own a lot of company? So that if I were to buy the stock, is management, along for the ride in terms of owning the stock with?
So yeah, I did look into corporate governance, and management does. Sorry, I am remember correctly, but management does hold most of the power over their shares. But as far as management's involvement is your question.
I was just curious in terms of making sure that the management team is incented along with equity holders. So sometimes like the management team is being grossly overpaid relative to other industry players. That's something that would be a red flag. Just more general corporate governance issues in terms of, in terms of potential risks.
Yeah, so I don't think management being a partner didn't look directly at their salaries, but I did look at a lot of the policies that they have, and they have a lot of really good policies when it comes to safety of their workers. And management also has like a lot of investment in making sure that, or like they have a lot of environmental commitment as well. And there's one more, but when I looked at through their policies and like read through all of them, they have a lot of involvement with
safeguards.
Yeah, and they also have like a whistleblower policy. They were just like very. It seemed from what I read that they're very involved with their workers, and so I saw that as a good attribute in their corporate governance. It was very clear, and it wasn't hard to find anything when I was looking into it, so you could access it. And then they also have, just as a plus, like a fund that goes out to the communities that they're working with.
So when you were reading the KQ, do they have any lawsuits?
I didn't see any, but I could have overlooked something.
So you highlighted that their debt levels seem high relative to the peer group you chose. Can you maybe talk through the risk associated with that and where their break-even price is when they would no longer be able to service their debt or no longer be profitable?
So for their debt, interest rates are in theory rising in the future. They've risen, I think, what, 1/4% or 0.5%. So immediately, we don't see it as being much of a problem because the Fed, at least in the past, have been very slow. They're not going to raise interest rates 10% the next year. So we don't see in the near term rising interest that to be a problem, given the current rates. We didn't do any kind of calculations for break even. I'm not sure. Is there a third part to the question?
No.
For the WAC you used to discount, how did you come up with the 6%? What were the inputs?
So for the, averaging debt and equity, for the equity, we looked at around 7 or 8% for an average of their PE and industry PEs of around 12.5 to I think 14.5. And then we adjusted that for inflation, so falling to around 5 to 6%. And then we also included their debt, which has a fixed rate of 6.87 or 6.75.
So you mentioned that they operate throughout North America. What kind of currency exposures do they face, and are there threats with current administration talking about closing borders?
I don't think so. I think at least in Mexico, where I think the peso is falling, they get paid in US dollars. And so I guess it would be possibly maybe contractors will not like that, but their direct exposure is not really there.
With so much of their value in their operations related to commodity prices, do they do any hedging?
They do hedge lead and zinc. They don't hedge gold and zinc.
I actually noticed in your guys' slide deck that you cited that the industrial demand has been declining for silver and gold. Do you guys have any idea why that is?
Yes. So for electronics, silver is used widely as a superconductor, and it's slowly being replaced with other cheaper metals as technology increases there. Within solar, photovoltaic cells are also, again, starting to move to other superconductors because silver is more expensive than many of the newer technologies they're finding. And yeah, that's mostly it. Those are the two biggest factors of industry fabrication.
So why you didn't choose to use alternative valuation models, DCF or multiples? Did you at least run through those to see, triangulate if how they compare to what your valuation was?
I mean, we did run some like drafts through them. However, I think at least again, projecting out their earnings is wild. It changes wildly.
Sorry, guys.
Good job.
Thank you.